Hi everyone, I want to start this video by talking about the lowest probability Elliott wave scenario, which is the one that I have on my chart, following by three scenarios that in my opinion all have higher probabilities than the one you see here. Now this is following my previous video where I already mentioned that I was unhappy trying to count this as a 5-wave impulsive move or a diagonal structure. But I jumped into the Elliott wave principle and checked some of the rules and guidelines, and I want to present that to you, and it has to do with diagonals. So first of all, an impulse to the downside here, a 5-wave structure, doesn't work. It's invalidated as wave 1 and wave 4 have overlap, which is a hard invalidation from an Elliott wave point of view. I do realize that on a few charts there is a $10, $20 difference, meaning there is no overlap between these two pivots, but on most of the charts there is overlap between those two pivots. Now alternatively, you would need to end wave 4 at the lower high over here, right? Because as mentioned in the update yesterday as well, there is a bit of a gray area which states that the price section of a wave 4 may overlap with a wave 1 as long as wave 4 does not end overlapping with wave 1. But if we put the end of wave 4 on this top, then clearly it overlaps with wave 1 on most of the charts. However, it is incredibly difficult from an Elliott wave point of view on the lower time frames to end wave 4 on this high over here, to then get a wave 5 here to the downside. There's only a few corrected structures. You have the zigzags, the flats, the WXYs, and the triangles. Now, if we want to talk about zigzag structures, then your wave C or your wave Y or your wave Z is always the highest structure. So that should be the top, but that is not possible in this particular case because we don't want wave 4 to end over here as it overlaps with wave 1. So zigzags are then going to be out of the question. However, at no moment in time did price retrace deep enough to consider a flat, because the minimum retracement target for a wave B in a flat, meaning a wave A here, A, B, and then a wave C, minimum target is the 0.9. At no moment in time did price retrace to the 0.9 Fibonacci to get a C to the upside for example, a running flat where A, B by the way actually needs to take out the origin of A in a running flat, and then wave C where wave C creates a lower high, right? And then you move to the downside. Not possible. Then we have to consider triangles, which is not a possibility here as well. You need to have a wave A, B, C, and then what? Where's my D and my E, right? Is this move down your D and that's your E? That of course feels incredibly forceful, right? Where you have a very long A, very long B, and then, B, then a wave C, and then your D and E are like one candle or less than one candle on a 1 hour time frame. Doesn't make sense, right? You get the idea. And then we get to the WXYs. And in a WXY, we are considering a sideways WXY, meaning a sideways WXY, where if wave W is a zigzag structure, because W can only be a zigzag or a flat. So a 5-3-5 ABC, right? Or a flat. Now, at no moment in time did we see a flat, right? So there is no flat going on here. So that's out of the question, which means wave W has to be a zigzag to the upside. So somewhere here, we then need a zigzag to the upside. And we don't need to count this in a lot of detail, right? Somewhere over here, we have the end of a W then as a zigzag. Maybe ABC, with A being a diagonal over here, and then C to the upside, right? Maybe W ends there. It doesn't really matter, because the problem is not W, the problem is wave Y. Because in a sideways combo, we have wave W, we have wave X, and wave Y. But if wave W is a zigzag, wave Y is not allowed to be a zigzag structure. It has to be a triangle or a flat. But even if we finish X here, there is no triangle. A, B, C, D, took out the lows here, doesn't work, right? Can we count a flat, A, B, C? No. Why? Well, wave B did not go deep enough, right? We didn't touch the 0.9 here. We missed out on touching the 0.9, meaning wave X cannot finish at this particular low, right? So then we have to think, okay, but where does then wave X finish? Do we need to finish it here? But then what's going to be the solution, right? A triangle still doesn't work. A, B, and then we need to have a C, right? And then a D and E, which again gives us the same problem of trying to force D and E into those few little candles there, but a flat also doesn't work, right? A, B, C, but your wave C needs 3 highs. These are only 2 highs, right? Wave C is either an impulsive move, 1 high, 2 high, 3 high, or it's a diagonal. But also here, 1, 2, 3, 4, 5, you look for 3 highs, unless there is a truncation. But even in a truncation, you would look for price action to do this, which is something we haven't got. So we also can't put X there. We can't put X there. So where do we even put wave X? Now, wave X can be any corrective structure, right? So that can make it tricky at times. Most commonly, it is a zigzag family structure. So a simple ABC or a WXY, which basically therefore means that ending wave X at a low or a high generally makes most of the sense, because a wave C or a wave Y tends to be the top or the low of a certain structure, right, in your wave X. If we finish wave X at one of these pivots, we're not looking at a zigzag family structure, because these are higher lows. And then again, you get into the struggle of how would we count this ending a structure here as a wave X, for example. And even if we would finish wave X here, this is a zigzag to the upside, which is not allowed. So we actually need to finish it here to create a wave A, B, and this has to be a wave C towards the upside. But how do we end wave X there, right? What kind of structure do we then need to have from at least the top, right? 1, 2, 3, 4, 5. Is that a truncation? Well, truncations are very rare. I think you kind of get the idea of what I am saying here, is that the probabilities are just very low that is the end of your wave 4. It makes a lot more sense than that's the end of your wave 4. But then there's overlap with a wave 1, which is not allowed in an impulsive structure. Now, there are incredibly rare, I suppose, structures at times, right? Incredibly rare, where, for example, a wave C does not take the end of wave A, or a wave Y of a double zigzag is not taking out the end of wave W. But that is so rare, like, guys, it doesn't make sense to give that a highest probability, which is basically where you have to move towards in this case. You got to really start thinking about scenarios that are completely out of the box, and it is very difficult to argument that like as a high probability Elliott wave scenario. So in other words, you can imagine as an Elliott wave analyst, it's not going to be your primary, right? It's not going to be your primary to try and force random shit in this particular range. It's generally better to stick with the simple stuff. And that is ending your wave 4 on the top, but then overlap with wave 1. So an impulse is then out of the question, right? On by far most of the charts, especially the bigger exchanges. Now then we get to a diagonal. And if we consider this move as a diagonal to the downside, right? Then we have a wave 1, 2, 3, 4, 5. You want overlap in a diagonal, so that's something that is possible, right? And then preferably all of the waves are 3-wave structures, so ABC in 1, ABC in 3, and ABC in 5, or WXYs, doesn't matter. A zigzag family structure, also in wave 4 and in wave 2, we need a zigzag family structure. But the problem here, right, is that this is an expanding structure. The trend lines are expanding, right? Because your wave 4 here dipped out of the channel top line, right? So in a contracting diagonal, you want the upper trend line to do this, right? That is a contracting structure. Now you have an expanding structure, right? As you can see, the trend lines are expanding. They're moving away from one another. So what I did is I jumped into the book, and this is online here, Elliott Wave Principle, right? Newest edition. And here it states, right? So basically what you're looking at is a summary of the rules and guidelines for certain waves, and then here is a diagonal, right? At the bottom of the screen it says rules, right? So these are the rules of a diagonal as per Elliott Wave International and the Elliott Wave Principle. And then it says here, going forward in time, a line connecting the ends of waves 2 and 4 converges towards, in the contracting variety, or diverges from, in the expanding variety, a line connecting the ends of wave 1 and 3, which basically means that in a contracting diagonal, a rule is that the lines are converging, not diverging, which basically invalidates a contracting diagonal to the downside here, right? But we cannot count an expanding diagonal here because wave 5 is shorter than wave 3. And a rule of an expanding diagonal is that wave 5 must be longer than wave 3. And if you take a trend-based subextension from the end of 2, end of 3, end of 4, toggle on the 1-to-1 here, then you can see that price did not reach the 1-to-1. Wave 5 is shorter than wave 3, meaning an expanding diagonal doesn't work. Therefore, the diagonals here do not work. But an impulse down also doesn't work. That means the probabilities are therefore automatically higher that this, right, is a corrective structure or part of a corrective movement, which automatically increases the probabilities that whatever is going on here is corrective, and whatever the exact price action is going to be, the probabilities are higher to look for price to still take out the all-time high at a later stage. Unrelated to taking out the low, continuing this range for another week or two, right? That's detail, that's detail. But the overall high time frame probabilities are higher for continuation, and they're lower for this being a 5-wave structure, either an impulse or a diagonal. Now, of course, on some charts you can count an impulse here because 1 and 4 don't overlap by $20, but on most of the charts there's overlap, which is a hard invalidation. And I count on the Coinbase chart, and the reason for that, the Bitcoin USD Coinbase chart, the reason for that is that back in the day I collected a lot of data on different charts to see how good they are for Elliott Wave counting. I checked the candles, I checked the wicks, I checked the bugs, I checked the scam wicks, etc. And the Coinbase chart that I use was the best chart that I found. And it has served me very, very well over all the past years that I have done Elliott Wave counting. So if there is overlap on my chart, I trust my chart to invalidate an impulse to the downside. Which then brings me, so that was quite a part of the video, of course, but that then brings me to the other scenarios, right? So I have a flat here, a WXY, which is what you see here on my chart, and another WXY, okay? So let's start with the flat. Right, so I spoke about this in the past couple of videos, right? As price was down here, looking for price to move up. As price was up here, we were looking for price to move down to follow up on a wave X. But in a flat, of course, 3-wave structure, ABC, and then we look for price to move up. Preferably, you miss out on the 0.7. Now, the 0.7 is not an invalidation for a wave X. It's just not preferred because it's very deep for a wave X, and a double zigzag is generally a sharp corrective structure, not a sideways corrective structure. So therefore, preferably your wave X ends somewhere between a golden pocket and a 382. The 0.7 it's touched, yeah, it does decrease probabilities. It's not an invalidation, so I still have it on my chart. Something that I pay attention to locally, yeah, what you can see here as well in the local move down, is at least the potential of this being some sort of a double zigzag WXY. Doesn't really matter, might move your W and wave X to the high over here, or just move it here to the low, right? To create an ABCWX, and then over here, ABC to the downside, right? Or you do this, it doesn't really matter. It zigzag a family structure to the downside to then create the low of your wave X on top of the 0.7. Now, the highest amount of volume is in the low. So you can see price move down, and the highest volume is in the low. Now, that is common for a wave 3, and then you get a 4 and a 5, right? Or a wave C or a wave Y, which are corrective structures. Now what matters is this one here. Because what I'm not looking for here is another 1, another 2, and then a wave 3 to the downside. I would consider corrective structures the moment the 618 is touched, because the 618 pretty much serves as an invalidation for a wave 4. It's so rare to have a wave 4 touching a 618 retracement, right? It doesn't make sense to really consider a wave 4. Now this 618 is pulled from this high to the low. Why? Well, the highest amount of volume sits in this last move to the downside. So preferably the ranges before is a multi 1-2, right? 1-2, 1-2, then you get your 3 and you look for a 4-5-4-5. But if price reaches the 618, wave 4, at least this one here, right, matching this wave 2, goes out the door. Now you could be more safe, right, and basically take the 618 from that pivot to the low over here, right? In case you then want to consider this as a wave 1, 2, and then, yeah, I actually don't know what I'm talking about now, because this cannot be 1, 2, 3, 4, and a 5, because over here we have overlap. So then once again, we have to start considering diagonals in this case, which then has to be It's not even expanding or contracting. I don't consider diagonals here, to be honest, but as we are talking about it, let me at least do it now. It's not a expanding diagonal, but your 5 is longer than your 3, so there's no diagonals really going on here, right? So anyway, I think the 618 that matters the most is the one I had on the chart here at 106.3k. If that one is touched, the probabilities are very low that this move to the downside, right, is an impulsive move. It then makes more sense that this move to the downside is a corrective structure in an ABC, or what I would prefer, a WXY double zigzag, ending on a high amount of volume, moving back to a 618, invalidating a wave 4, right, which would continue the range / probabilities higher for a move towards the upside, right? That's basically what this one here means. So that's an interesting one to keep an eye on. Price also moved down to the daily naked point of control, right, at 103.2k. Probably should have shown it in the video yesterday, but that is a level that price hit, as you can see, and price reacted nicely, moving now towards the upside, and we'll see, maybe we can touch the 618 during the video, maybe not, but at least keep an eye on the 0.618, invalidates a wave 4, which therefore makes this scenario still very interesting, right? So in that case, what we have to see though, is we need a 5 wave up, 3 wave down, and another 5 up to finish Y, therefore finish B, and then move down in a wave C, okay? Now preferably, wave B of a flat is taking out the all-time high, which is the origin of your wave A. So if your wave A, B, C, preferably the origin of A is taken, but a minimum flat target is the 0.9 at 110.8k, which we haven't reached with W. So even just taking out this high, touching the 0.9 would be fine. Right, but it is just quite common for price to take out the origin of A. This is always an interesting pocket, the 1.236 to the 1.38, 114.7, 116.4k, right? And then we need a C to the downside to move back into the range, okay? So, okay, cool. Then we get to the WXYs that I have on my chart. I am not considering, by the way, triangles here. Right, so for a triangle, wave A preferably is a simple zigzag in a 535. It is a bit tricky to count a simple zigzag here. Let me actually start with it, because the only way that I could count a simple zigzag to the downside here would be as this. So we have a wave A, we have a wave B, and then an expanding diagonal, wave C. 1, 2, 3, 4, 5. Now I checked the stuff here, so this one works in theory, right? Wave 2 here retraced deep enough, right, to the 0.5, which is generally a minimum target for wave 2, and an expanding diagonal, right? Wave 4 retraced to the golden pocket, which is fine. Wave 5 is longer than your wave 3, which is good as well. 3 longer than 1, which is just nice to have. It's not a requirement. And your wave C in this case is finishing around the 1.618, which is fine as well. But of course, an expanding diagonal, it is not a very common structure, which we have to take into account. But then this ABC, in what I have here on my chart, is a W, then you have your X, and you would look for a Y in a triangle or a flat, which would basically be A, B, C, D, E triangle. Wave A, however, by far most commonly should just be a simple zigzag in an ABC to the downside. I do preferably count this probably as a double zigzag structure, so I'm not really fancying a triangle. It's also too early to talk about triangles. We just don't have the data yet. Generally, a triangle only becomes relevant at wave D or E, and then here we are. Wave A maybe finished, maybe not. No, so it's a bit early. Flats in general have a higher probability where you look for wave A, wave B, takes out the double top potentially, get a wave C towards the downside, right? Maybe not even take this low, create a higher low, and then eventually move towards the upside, right? So you basically fake out a potential breakout, grab some of the liquidity, move impulsively to the downside, people scared, take out this low, create a higher low here, and then turn towards the upside. It's interesting, it's interesting. Now, because you could theoretically push a zigzag in here. Of course, a bigger triangle, A, B, C, D, E, is an opportunity, but it's too early. It's too early, doesn't make sense. You got to wait for D and E and just a lot more information. Which then brings us to the final scenario. I covered this scenario actually a short while ago. But then I removed it from my chart because wave X is very shallow for a sideways WXY. That's what you're looking at here. So you have a W zigzag, you have X, and then a flat in the wave Y, which basically means this has to be a 5-wave structure, which of course, if price would touch the 0.618 here, probabilities will be low for this to be a 5-wave impulse. So we should actually have this 618 here on the chart. All right, 106.23K. Now, the reason why the probabilities aren't too great is because in a sideways WXY, preferably your wave X is retracing high. All right, so this is only a 382, which would be common for a double zigzag, for example. But in a sideways, and a double zigzag would be zigzag W, X, zigzag Y. But in a sideways WXY, where W is a zigzag and wave Y is another structure, triangle or a flat, you preferably get a wave X that moves to the golden pocket 786, 886, right? Or even takes out the origin of W. So this is incredibly shallow, but I was reminded by, I believe, Razor in Discord, that it's still a scenario, right? It's still, there's no invalidation. It's just wave X is incredibly shallow, and you need an impulse down in a wave Y here for your wave C in a flat in this particular case, right? Unless you get a triangle A, B, C, D, E. Right? Because that's also, of course, still a possibility. Wave Y is either a flat or a triangle if wave W is a zigzag, right? So that is at least something we can consider as well. And in that case, we don't need an impulse to the downside. We can have a WXY in wave C of a triangle, which, side note, if you do have a more complex structure in a triangle, it is commonly wave C. Right, so this would be a running triangle. You have a wave A, wave B, C, D, E. Right, so you want to continue to range sideways, creating higher lows, and after wave E, you move towards the upside. You want the high to be taken. Right, that's what you're going to be looking for, or at least a move to the 0.9 Fibonacci taken from the start to the end of your wave W. But by all means, you're first going to move sideways for a longer period of time. Okay, so that is definitely also one to keep an eye on. So I mean, I don't even know how long this video is because I'm using only one screen, so I can't really check the time. So I just keep talking. But in a nutshell, right, without going into specific Elliott wave scenarios, the main goal of this particular video was actually the beginning, right? So about debunking a 5-wave move towards the downside. To me, it is the lowest probability Elliott wave scenario. Like, happy to be proven wrong, I don't care. But the probabilities are highest. The move down from all-time high is corrective, which means that at a later stage, we expect the all-time high to be taken. And it's in theory, right? So the move down, it's in theory unrelated to the exact price action locally and the range forming, right? So in theory, it doesn't actually really matter what corrective structure we are then looking at, as in general, the probabilities are higher for continuation to the upside, right? When we zoom out to a higher time frame, okay? So the probabilities are higher. This is corrective, cool. That means we're looking for continuation unrelated to the exact corrective structure, right? Whatever, takes out the low, continues the range. I shared a couple of ideas, stuff that I am looking for, right? In general, you're looking for price to move towards the upside. I hope that this video was helpful or valuable to you. On the left, you see a video on the simplest way to use and trade Elliott waves without even counting. And on the right is the Elliott Wave educational playlist to help you understand more about Elliott waves. Thanks for watching and subscribing, and I hope to see you at the next one. Bye bye.